Welcome to Ilagan Whiteboard Friday, where we look at complex legal and compliance issues in a simple to do way. This series is brought to you by Ilagan, your partner and provider of end-to-end business services.
Hello and welcome to Ilagan Whiteboard Fridays, where we look at various tax and compliance related issues in a user-friendly fashion. Today we will look at a very hot topic called SME listing. So very recently SEBI announced and the government of India announced that they would allow corporatization of small and medium sector. So they have come out with something called SME Exchange, where SMEs can list their equity and go public. Now let's look at what exactly is an SME Exchange. SME Exchange is a well-proven concept in a couple of countries. For example, London, Japan, Hong Kong, Korea. They all have an SME Exchange where they provide a special platform where SMEs can list their stocks and do a public trading. Now, the governing body still remains SEBI, which is Security and Exchange Board of India. So they have released the guidelines for SMEs to go about a listing process or a public issue. Currently, they have also allowed anybody, there are certain rules who can set up an SME exchange. And right now, BSE, which is Bombay Stock Exchange, and NSE, National Stock Exchange, have both come out with a special platform. So at BSE, it is called BSE SME, and at NSE, it's called NSE Emerge. So these are the two platforms where you can go ahead and list your equity. Now let's look at what are the advantages of going for an SME listing. So see, when you are in a growth mode and when the business is growing, you need a lot of capital to sustain the business or for the growth reasons. Now that could be challenging because your equity base could be small, and if you are raising equity money, then also like from various private placements, for example VC funding or angel funding or from friends and family, the equity base could be very small. So that's how that's the time when you should actually look for SME listing. This also helps VCs to get an exit option. So once you go public, they also get a very good exit route. They don't have too much lock-in period, so they can exit at any point of time. And it gives a much more better branding for the whole company. So once you are a public company and a listed company, then you get a lot of media attention, a lot of media talks about you, get a very good branding. The transparency level increases suddenly, which is not very common with the private limited companies in India, because a lot of private limited still try to hide a lot of figures and don't do a lot transparent deals. But as soon as you go and list to any of the exchange, your compliance requirement, your regulatory requirement changes a bit, and where a lot of transparency comes into the overall system. So anybody who is trying to do business with you, that they also get a much more confidence about the whole company. So you get a very good media rollout. You get a very transparent relationship with various stakeholders. Your employees, so a lot of companies give ESOPs to employees. So the employees, until when it is in a private limited mode, they have to actually go and find a buyer, and which is very, very challenging at that point. So once you go listing, it actually gives a very tangible benefit. So for the existing employees also, or even for new recruitments, you can show them, okay, I'm giving you this much worth of stocks. So that gives a very credible and gives you a very good flexibility and power to hire a best of the talent or the right talent, or to retain them. Now, who should go for it? Now, SEBI has given the guidelines for SME listing. Some of the criteria we will look at it at the listing criteria. Let's look at who should go for it right now. So companies who are having a very good cash flow, who has it should not be at a lakh or 2 lakh level, but multiple crores is ideally a good thing. But if your business is very, very promising, then even at an earlier stage you can actually go for. Otherwise, companies which is typically about 4 to 5 years old is what they should be looking at going public. So in 4 to 5 years, you certainly have a very good order book. You get a very good tangible assets, intangible assets. You also have a profitability history. You have a very decent cash flow size. So it's not for companies which are like 1 or 2 year old, but rather 4 to 5 year old company is where you should be going for public. Now let's look at some of the listing criteria, and that would also give you a fair knowledge as to when you can go ahead and list it. So one of the criteria that is listed is the company should be at least 3 year old, right? So company should have 3 year old, out of which 2 years profit history should be there with the company. So again, we will look at it in much more detail when we look at each of the listing criteria and process for BSE and NSE separately. But one criteria is you should have about 3 year old history. Then there is a maximum criteria defined. So your post issue capital base, the face value of the authorized or paid up capital, I would say, not authorized, should not be more than 25 crores. So if you are trying to raise money from the public, and if your overall equity base is going to be under 25 crores, then only you can actually go ahead with SME listing. If it is more than that, then you will have to look at the main exchange like BSE, NSE and all. So that's one criteria. Then SME exchange has currently been like prohibited for retail investors. So the minimum tradable lot size or the minimum transaction value is defined at 1 lakh rupees. So anybody who is trying to trade into SME stock should actually be trading in minimum tradable lot of 1 lakh rupees. That's one criteria which SEBI has announced. Then 100% underwriting is mandatory. So you need to find an underwriter. Typically merchant bankers is who are the people who help you with underwriting the shares. So all the 100% of whatever you are offering has to be underwritten by them, and at least 15% of that has to be into their account. That's one criteria which you should be aware of. And minimum offer like to the public should be at least 25% of the equity base. So you should be offering a minimum amount of 25% dilution to the public. It's again one of the criteria that at the initial public offer, when you are actually going live for the first time public, the minimum number of shareholders or applications that you would receive should be about 50. So that's not a regular monitoring criteria, but that's our first defining criteria. So these are some of the listing criteria. We will come back to this in a much more detailed when we look at this specific exchange, because every exchange has their own listing criteria. So the process for listing is generally you have to file something called DHRP, which is draft red herring prospectus. So DRHP is what you have filed with the exchange, and you have to fill up an application form. You have to submit your memorandum and all. And there are some more criteria or eligibility criteria which we will look at it in detail. So this is overall the process of going public for SMEs. So there is certainly a lot of advantages, but again it's not for everybody. If you are a growing company or if you have a minimum growth, 3 years of history, then only you can start looking at it. That's it on this topic. Please feel free to drop us an email at support@elagan.com or check out our knowledge base at elagan.com/kb for much more details on this. And we also recommend to talk to an expert before taking a call, whether it is right time for you. You can do a preliminary analysis with them before taking a call if it is the right time to go ahead with an SME listing. Thank you for attending Elagan Whiteboard Friday. Thank you.